This 80-year-old checklist for value investing still works today if you know how to update it. Stick around. Welcome back to Stonkcast, the market show for the average Joe, whether you're a diamond-handed degenerate looking for the next 500% play or a more conservative swing trader or investor, we've got you covered. We tackle the latest market news, give our 2 cents, and maybe, just maybe, help you make some money along the way. I'm your host, as always, Brandon Shar. Welcome back, folks. We are in part 3 of the value investing series, according to Benjamin Graham, the author of The Intelligent Investor. In episode 1, a couple weeks ago, we did a quick biography of Benjamin Graham. And then in episode 2, we actually tackled a little bit more of Benjamin Graham's philosophy when it comes to investing. And today, as promised, we are getting a bit more practical, applying Benjamin Graham's criteria for value investing for today, 2025. So let's get right into it. So first of all, Benjamin Graham had a couple different ideas of what an investor can look like. And so we're going to briefly just break down what those 2 types of investors is. He describes it in The Intelligent Investor, what they look like. And then we are going to apply it for today with inflation and bond rates. So if you are interested in finding a way to apply his principles practically to today, you're in the right spot. Don't forget to like and subscribe and follow wherever you listen to podcasts. All right. So first of all, let's take a look at one of the classifications according to Benjamin Graham of an investor as he lays it out in The Intelligent Investor. So one is going to be a defensive investor. This is going to be the type of investor that prefers a hands-off, conservative approach with minimal time spent on analysis. Graham's criteria were designed to reduce risk and avoid speculation. So just as a refresher, we talked about it last week, but there is a difference, according to Benjamin Graham, between an investor and a speculator. Speculator is going to be someone more so like a degenerate looking for 500% option plays. An investor is going to be someone in for the long haul. In my opinion, this would be somebody with a holding time of a minimum of a year, right? You should never be getting hit with short-term capital gains when you're doing investing unless something horribly goes wrong. So for Benjamin Graham, when it comes to a defensive investor, he's looking for adequate size of the enterprise. So for industrial companies, that would be sales of at least 100 million in 1970s dollars, adjust for inflation. For public utilities, assets of at least 50 million. And keep in mind, these numbers seem low because they are, because in Benjamin Graham's time, the revenues were less than what we see today. Of course, over the course of, decades upon decades, companies have gotten bigger and bigger, and that's why we're here. That's why we're adjusting these numbers. But I just want to lay out just some of the points of what he classifies in his book as, these types of investors. So sufficiently strong financial condition, a current ratio, which is going to be current assets divided by current liabilities of at least 2. Long-term debt should not exceed net current assets. Earning stability is also important. Positive earnings in each of the past 10 years, showing a good dividend record, right? So uninterrupted dividend payments for at least the past 20 years. Excuse me. Earnings growth, a minimum increase of 1/3 in per share earnings over the past 10 years, using 3-year averages at the beginning and end. And if you haven't caught on by now, today is going to be a bit more technical, a bit more math. But again, if you're interested in value investing, these are things you need to know and pay attention to. Moderate price to earnings ratio. So Current price should not exceed 15 times average earnings of the past 3 years. Moderate price to book ratio. Price should not exceed 1.5 times the most recent book value. Alternatively, the product of PE ratio times price to book should not exceed 22.5. And then you have the classic Graham number formula. This is a way to get a conservative estimate of what the company should currently be valued at, trading at. And it's going to be the square root of 22.5 times earnings per share times book value per share. And these are all metrics you can easily find, which I will be showing next week in our last part of this investor series in part 4. So that is a defensive investor, according to Benjamin Graham. The other criteria here would be an enterprising investor, which is what we are going to focus on today. These investors are willing to put in more effort, take on more risk, and perform deeper analysis in search of better returns. So strategies and criteria for the enterprising investors. Graham was less rigid with enterprising investors, but he suggested they look for undervalued stocks. So low price in relation to earnings, book value, and other financial metrics. Financial soundness. So strong balance sheets, though not necessarily as strict as for defensive investors, still important, right? And then earnings stability, a history of consistent earnings, though the 10-year rule may be relaxed. Low debt levels. So preferably companies that can survive economic downturns, and then special situations or bargains. So he would call this net nets, meaning stocks trading below net current asset value. So if you can find a company that is currently trading below the cash they have on hand, this would be considered a net. Stocks of companies undergoing restructuring, liquidation, or spinoffs would be examples of this. And then lastly, price discipline. Always insist on a margin of safety, as we talked about last week. Buy at a significant discount to intrinsic value. That is very, very important, according to Benjamin Graham. So these are the criteria that we have for these types of investors. And like I said, we are focusing on the enterprising criteria. And so the reason we're making this episode, the reason we're updating this criteria is because things have changed. Here's a great example. In Benjamin Graham's time, right? 1950s, the bond yield was about 2%. Inflation was 1%. If we look to today, well over half a century later, bonds are yielding about 4.5% on average, and inflation is closer to 3 to 4%. That's a bit higher than I think what we're currently at now, which is below 3%, but still, you get the idea. Inflation is higher than it was in Benjamin Graham's time, and that will affect the criteria and how we use it. So this is the difference, and this is why we need to adjust it for today if we're going to, apply it to the market. Also, keep in mind that in Benjamin Graham's time, technology wasn't really a thing. Technology sector wasn't really a thing. He mainly focused on utilities, right? That was one of the big ones for him. Also industrial stocks. And so a lot of his criteria is applicable to those sectors. And so with a little help from ChatGPT, I basically plugged in Graham's criteria for an enterprising investor and applied it to where we're at today in the year 2025, accounting for current bond yields, accounting for current inflation rates, and also accounting for the fact that we have some more prominent sectors, such as technology, that Benjamin Graham didn't really deal with, right? And so that's where we're at right now. And let me show you the breakdown of that. And again, Graham's enterprising investor criteria, this is basically what ChatGPT adjusted the numbers for. So for Benjamin Graham, he would be looking at revenues over, like I just said, 100 million, right? Or maybe 400 million, things like that. But because of the size of companies that we have today in the world's largest, stock market, we need to adjust those numbers. So this is the updated criteria, and then I'm going to show you a breakdown for each of the spider sectors, right? So you have the S&P 500, the 500 largest companies. It is a great indication of where the market is at right now. And you have 11 sectors, select sectors within the S&P 500. They all have their different weights, but T was gracious enough to break down the numbers for me to apply to each sector, and that's what we are going to cover today. So first of all, just an overall view of Graham's enterprising investor criteria updated for 2025. So first of all, the revenue size has to be greater than 800 million. You need a current ratio greater than or equal to 1.5. Long-term debt less than 110% of net current assets. Earning stability, positive earnings in greater than or equal to 5 of the past 10 years. Earnings growth greater than or equal to 50% growth over the past 10 years, or 4.1% CAGR, which stands for compound annual growth rate. You need a PE ratio less than 18 based on an average of the past 10 years. And then finally, price to book, or a Graham number, right, is going to be the price to book less than 1.5, or the price to earnings times the price to book is going to be less than 22.5. So those are the criteria. And I said, hey, ChatGPT, break this down for me for each sector so that I know what to be looking for within these sectors within S&P when I'm looking for potential investments. So first of all, let's go with XLC, which is going to be communication services. For those on YouTube, definitely recommend, pausing this, taking a screenshot so you have these charts. If you're listening on iTunes, Spotify, Pocket Cast, whatever, I would definitely advise, if you really want to get into the nitty gritty of this and have these criteria, of course you can jot it down as I'm saying it, but going on YouTube and actually getting the visual here where you can screenshot it might be more valuable, saving you more time. Communication services. So this is going to be for firms like media, like communications and entertainment. Revenue size greater than 800 million. Earning stability, positive earnings greater than or equal to 5 of the past 10 years. Nothing really changing there. And I like that ChatGPT gave an explanation for each one of these, right? So adjusted, when we talk about the revenue being greater than 800 million, this is adjusted from 100 million for industrials, as Graham had it, based on latest fiscal year. Positive earnings required for consistency, especially in cyclical sectors like media, right? So this is a sector that is constantly changing, very sensitive to the overall market, and so you want to make sure that you have those positive earnings. Earnings growth greater than or equal to 50%. This allows for growth potential, particularly in telecom and media. PE ratio under 18, higher than typical due to some sector stability, but still conservative. Price to book ratio less than 1.5. Companies may have less tangible assets in the sector, but book value is still important, right? Debt to equity less than or equal to 2. Moderate debt tolerance due to capital intensity in telecoms. And then a dividend record. So 5+ years of uninterrupted or stable dividends for stable telecoms and dividend paying media companies. So that is XLC for communication services. Second one here is going to be consumer discretionary for sectors like retail, apparel, automotive, entertainment. These are pretty much the same. If you notice, though, the price to earnings ratio requirement here is a little bit less. So where we had less than 18 for a PE ratio for communications, when it comes to consumer discretionary, we're looking for a price to earnings ratio less than 15. This is slightly lower due to sector cyclicality and volatility. And then price to book ratio is going to be the same as communications. Debt to equity, however, is a little bit less. So with communications, we're looking for debt to equity less than or equal to 2. With consumer discretionary, we're looking for a debt to equity less than or equal to 1.5. So higher debt allowed, but moderate compared to more cyclical sectors. And then again, 5+ years uninterrupted or stable dividends. Consumer staples. This is going to be for sectors like food, beverages, personal care, household goods. Sticking with that 800 million threshold for revenue size of the company. Again, at least 5 years out of the last 10 being earnings stable. You also have earnings growth here, which is a little different. So only 30%, greater than or equal to 30% over the past 10 years. This is slower growth than discretionary, but still positive. The PE ratio here, we have a bit more leeway for consumer staples. We're looking for less than 20 for a PE ratio. Slightly higher due to stability, but still within value bounds. Price to book ratio, the same, 1.5. Debt to equity, less than 1.5, less than or equal to. And then dividend record, at least 5+ years. So that is the consumer staples breakdown. The next one here, energy. For sectors like oil, gas, and alternative energy, revenue size, again, at least 800 million, positive earnings, greater than or equal to 6 of the last 10 years. Energy is cyclical, right? So stability is key to avoiding risk. Earnings growth, greater than or equal to 50% over the past 10 years, or compound annual growth rate of 4%. PE ratio here needs to be less than 12. Lower PE due to commodity-based volatility. Price to book ratio less than 1.5. Debt to equity less than or equal to 1.5. And again, 5+ years uninterrupted or stable dividends, especially for established oil and gas companies. All right, next up, financials for sectors like banks, insurers, investment firms. This one's a little different when we look at the revenue threshold. Basically, you're looking for total assets greater than 400 million. This is adjusted from 50 million for financials. Earnings stability, greater than or equal to 5 of the past 10 years. Financial firms require steady earnings. Earnings growth, greater than or equal to 50% over the past 10 years, or a 4% CAGR. And then PE ratio needs to be less than 14 for this sector. Lower PE to reflect the more cyclical and leveraged nature of the sector. Price to book ratio less than 1.2, or less than that price to earnings times price to book. The price to earnings times the price to book needs to be less than 22.5. So you can have either one of those for each of these sectors. Either the price to book ratio is less than whatever the number is for that sector, or price to earnings times price to book needs to be less than 22.5. Debt to equity less than or equal to 2, and then 5+ years of uninterrupted or stable dividends. Next up is healthcare, XLV, for sectors like pharmaceuticals, biotechnology, medical devices, health services. Revenue size greater than 800 million. Earning stability, again, positive earnings in greater than or equal to 5 of the last 10 years. Earnings growth greater than or equal to 50% over the past 10 years, or a 4% CAGR, which again stands for compound annual growth rate. PE ratio of less than 18. A price to book ratio less than 1.5. Debt to equity less than or equal to 1.5, and then 5 years of dividends. Industrials for sectors like transportation, construction, aerospace, machinery. Revenue size greater than 800 million. Positive earnings 5 of the last 10 years. Earnings growth greater than or equal to 50%. a PE ratio less than 18, a price to book ratio less than 1.5, debt to equity less than or equal to 1.5, and then 5+ years of uninterrupted or stable dividends. And then materials, XLB, is the ticker symbol for this select sector in the S&P 500. This is going to be for sectors like chemicals, metals, mining, forestry, right? Revenue, we're still looking for over 800 million. Earning stability 5 of the last 10 years. Earnings growth 50% over the past 10 years. PE ratio under 15. Price to book under 1.5. Debt to equity less than or equal to 1.5. 5+ years of dividends. And then just about done here. Real estate for REITs and property related firms. For those who don't know what REITs are, it's real estate investment trust. It's a way that you can, without being a landlord, get access to basically the real estate sector and be a part of it. So for this one, we're looking at a revenue size that is greater than 800 million. So real estate companies, especially REITs, should have enough scale to generate consistent revenue from rental income and property sales. Earning stability greater than or equal to 5 of the last 10 years. Earnings growth greater than or equal to 50% over the past 10 years. PE ratio less than 20. And then price to book less than 1.5. Debt to equity, this one's a bit higher. So debt to equity less than or equal to 3. REITs often carry higher leverage due to their capital intensive nature. So a higher ratio can be acceptable here, but it shouldn't exceed 3, ensuring the debt load is manageable. And then for the dividend record here, instead of 5+ years, we're looking at 10+ years of stable or growing dividends in the real estate sector. REITs are primarily dividend paying entities already. So a stable or growing dividend record is key for investors in this sector. All right, and then technology. So XLK is the ticker there for sectors like software, hardware, IT services, semiconductors. This one is adjusted accordingly for technology, which is a high-flying industry. So a little different here with the revenue size. Majority of these sectors, we're looking for revenues greater than 800 million, whereas in the technology space, we're looking for a revenue size greater than 2 billion. So larger scale is needed for mature tech companies. Earning stability, same as the rest of them for the most part, greater than or equal to 5 of the last 10 years. Earnings growth, greater than or equal to 50% over the past 10 years. PE ratio under 20 here, same as real estate. Price to book ratio, we have a bit more leeway here. We want less than 2. Somewhat higher price to book due to intangibles and intellectual property that you're going to run into in the technology space. Debt to equity less than or equal to 2. High leverage may be acceptable depending on the growth stage the company's in. And then dividend record 5+ years, right? So that is technology. And then lastly here for the 11 different sectors in the S&P, we're looking at utilities, ticker symbol XLU. This is for sectors like electric, water, gas, and renewable utilities. We're looking at a revenue size greater than 800 million, positive earnings in 5 of the last 10 years. Earnings growth greater than or equal to 50% over the past 10 years. PE ratio less than 20, price to book ratio less than 1.5. Debt to equity less than or equal to 2.5. And then a dividend record of 10+ years of stable or growing dividends, right? So that's a lot of information in a short amount of time, but these are the practical breakdowns for each sector of the S&P. And the reason I love this is because of that fact. It is so practical. You can literally plug these numbers in and find stocks, find companies that meet these criteria depending upon the sector they are in, and they are in line with Benjamin Graham's investing philosophy. That's why I love this. So if you are a long-term investor, which if you're still listening at this point of the episode, I would assume you have an interest in that. This is something that can seriously help you find actual good investments, and the reasons for those investments are laid out here. It's fantastic. So, like I said before, make sure to, take a screenshot as, I'm scrolling through these charts here. That way you can copy them down for yourselves. Also keep in mind here, intrinsic value is another key component for Benjamin Graham. We've talked about this before, but according to him, it's the present value of all future earnings or dividends discounted back to today, right? So we want to adjust Benjamin Graham's intrinsic value formula for today. That's important. So to account for current bond yields, use the Graham-Robertson formula according to ChatGPT. So basically what you're looking at here is going to be the intrinsic value equals earnings per share times 8.5 plus 2, and then you got G here, times 4.4 divided by Y. It's a lot of math, but to break it down, the EPS is going to be the trailing 12-month earnings per share. The G represents expected growth rate. So Graham used a 5-year or a 10-year historical average. And then the 8.5 is the PE ratio for a no growth company, right? So basically, and keep in mind that the 4.4, it's average historical AAA corporate bond yields. And then the Y in this equation is current AAA corporate bond yield, say 5.5% as of early 2025. So you can literally take this equation and adjust the earnings per share, depending upon which sector you're looking at, and you can literally find the intrinsic value of whatever company you're looking at. And if it's trading, for less than what the intrinsic value is, you could be looking at a good investment. You could be looking at something there that has a margin of safety. And then for those who really want to get into the nitty gritty, this is a chart of basically how you can adjust the PE estimates for that 8.5 in this intrinsic value equation based upon the different sectors, right? So, for example, consumer staples, 8.5 to 10. But if you look at, technology, it's higher, right? Graham would demand strong balance sheets and profits, higher PE for proven tech companies, right? So basically, you would plug into this intrinsic value equation for a tech company in place of 8.5, anywhere from 11 to 14, right, to adjust for that. So I know that is a ton of information. As you can tell, I definitely nerded out on Benjamin Graham's criteria and what, it would essentially look like for today. And I think it's important. I think we've talked about it before, but a lot of people think they're investing, but they are actually speculating, which is what put me on to Benjamin Graham's book, The Intelligent Investor, because if I'm going to be investing, I want to actually be investing. I don't want to be speculating. That's dangerous. If you think you're investing but you're speculating, that is a recipe for disaster. And so what's incredible is that we have tools like ChatGPT, right, or Grok or whatever you use, where you can take some of these practical criteria that Benjamin Graham lays out and adjust it for today. That way you can actually apply it to current bond rates. You can apply it to current inflation and actually get an idea of what you should be looking for. So that is a layout of the practical numbers, the criteria that Graham used in his day and age, and then adjusted for where we are today in the year 2025. Graham's rules still work, right? But you have to update your filters for today's economy. Next time, I will show you exactly how to set up a screen so you can actually find these. I generated a Google sheet and actually have already found quite a few companies that meet these criteria depending upon the sector they are in. I will share that next time. I currently have them bought in a paper trading investing account, right? Just to see what it looks like. I'm going to test it out for a year and see what the returns look like. I think so far I've found probably about 15 to 20, but they are out there, folks. You can find them, especially given the recent volatility we've had. It's put some really, really great companies on discount. Definitely a buying opportunity for some of those value investors out there. So next week, we will go over exactly how to set up the screen, as I said, and when to actually pull the trigger based off of what those numbers look like. So if you want to find out more, definitely make sure to hit that like button, hit subscribe so you get notified. The final part of this value investing series, part 4, I will put out next Saturday, so be looking out for that. And as always, I will be back tomorrow for a market recap. Let's see what we got going on for the week ahead. We are smack dab in the middle of May. Markets are looking pretty great right now, closing in on a new all-time high, if you can believe that, after the last month we saw. So I will be back tomorrow for that. As always, thank you. And remember, folks, plan the trade and trade the plan. Have a good one.